OG John AG is here. Something is happening inside the silver market right now that most people are completely missing. Not because the move is small, not because the data is hidden, but because the average person is too distracted, too busy scrolling, too busy watching headlines about stocks, politics, and the Federal Reserve to realize that one of the most important monetary signals of this decade may already be flashing right in front of them. Silver is moving. And I don't mean a normal little rally. I don't mean a random bounce. I don't mean some short-term spike that disappears by next Friday. I mean silver has started moving like a market that is waking up after years of suppression, years of neglect, and years of being treated like gold's weaker little brother. And the scary part is this: most people are still not paying attention. In just 14 trading days, silver has exploded through price levels that many analysts said were impossible to reach this decade. Gold, the metal everyone watches, the metal every headline follows, the metal every central bank talks about, has mostly been sitting still. But silver is not sitting still. Silver is running, and when gold and silver stop moving together, when one metal stays quiet and the other begins sprinting on its own, history tells us something major is starting to break beneath the surface. Central banks that ignored silver for almost a century are suddenly looking at it again. Asian vaults are pulling in physical tonnage at levels we have not seen since before the iPhone existed. American warehouses are being drained. Shanghai premiums have exploded into double digits, and now, a brand new Federal Reserve chair is walking straight into a $40 trillion debt trap with no clean exit door. This is not just a rally. This is not just excitement. This is not just another trade. This is a repricing. You're watching the source code. And over the next few minutes, I'm going to walk you through exactly what is happening, why it matters, and what the smartest money in the world appears to be doing quietly before the rest of the market wakes up. Hit that subscribe button, join the source code, drop your city in the comments so I know where in the world you're watching from, and let's get into it. Let's start with the numbers, because numbers do not argue. Numbers do not get emotional. Numbers do not care about anyone's opinion. At the end of April, silver was sitting quietly around the $71 zone. Nothing dramatic, nothing exciting, just slow, boring, sideways movement. Most retail investors had already written it off. The forums were dead. The YouTube views were weak. The excitement was gone. Silver had become invisible again. Then, almost without warning, the chart broke open. Within 10 days, silver was trading above $73. A week later, it pushed through $80. And by the middle of May, silver was printing prices in the mid-80s. That is almost a $14 move in a very tight window, and it caught even experienced traders off guard. Now, some people will look at today's pullback and immediately say, that's it. The move is over. Don't make that mistake. Sharp pullbacks inside major structural moves are not always the end. Sometimes they are simply the market breathing. Every serious commodity bull market in history has had these violent step-back moments. The price runs hard, pulls back, shakes out weak hands, resets, and then builds for the next leg. That is how big moves are made. They do not move in a straight line forever. They climb, they correct, they shake people out, and then they continue. But here is what makes this move different. The buyers stepping underneath this silver market do not look like the same buyers we saw back in 2020. These are not just excited retail traders chasing headlines. These are deeper pockets, quieter pockets, longer-term pockets. And they are not buying silver to flip it next week. They are accumulating. And here is the clue almost nobody is talking about. For decades, silver has been treated as gold's little brother. Gold leads, silver follows. Gold rallies, silver rallies harder. Gold falls, silver usually falls twice as fast. That has been the rule. That has been the relationship, but that relationship has started to break. Over the last several trading sessions, we have watched gold trade flat, and sometimes even slightly lower, while silver has climbed $2 or $3 in the same window. That is not random. That is a fingerprint. It is the fingerprint of structural demand showing up in one metal more aggressively than the other. And why is that happening? Because gold and silver may sit next to each other in a coin shop, but right now they are two very different markets. Gold supply is tight, but it is still relatively stable. Silver supply is different. Silver is sitting inside a real, measurable, documented deficit. And when a paper market can no longer hide a physical shortage, that is when the price finally starts telling the truth. Silver is no longer trading only as gold's shadow. Silver is starting to trade on its own gravity. And right now, that gravity is pulling in one direction. Now let's move east, because that is where the real story is unfolding. While Western traders are panicking over red candles and arguing on social media, something extraordinary is happening on the Shanghai Gold Exchange. Physical silver prices in Shanghai have touched levels near $100 an ounce. That is not a prediction. That is not some fantasy forecast. That is not a YouTube thumbnail number. That is actual physical silver changing hands on one of the most important metals exchanges in Asia. Now compare that with the price in New York. During the same window, the US spot price has been hovering in the low 80s. That gap, somewhere around $14 to $16 per ounce, creates a premium north of 16%. Think about what that means. Chinese buyers are willing to pay more than 16% above the Western paper price just to get their hands on real physical metal. When that kind of premium appears in any commodity market, it is almost never meaningless. It means the official price and the real-world price are starting to separate. And there is another layer underneath this that makes the situation even more serious. The Shanghai futures market is currently in backwardation. That word sounds complicated, but the meaning is simple. Backwardation means buyers are paying more for silver right now than they are willing to pay for silver delivered later. In plain English, it means people want the metal today, not next month, not later. Today, and in every serious commodity textbook ever written, backwardation usually points to one thing: physical tightness, physical shortage, immediate demand. Now let's zoom out and look at the country-level data, because this is where the story stops being just a chart and starts becoming a strategy. In one recent month, China imported roughly 836 tons of silver. Let me translate that into a number that is easier to understand. That is around 27 million ounces of physical silver pulled into the country in about 30 days. That is the highest monthly silver import number China has recorded in 17 years of available data. Not just a strong number, not just a high number, the highest recorded. So the obvious question is simple: where is all that silver going? And the answer is uncomfortable for many Western analysts. Because that metal is not simply being flipped by traders. It is not just moving into ETFs for short-term speculation. It is being absorbed. It is going into industrial supply chains. It is going into solar panel production. It is going into electronics. It is going into state reserves. It is going into hands that may have no intention of selling it back into the market anytime soon. This is what accumulation looks like when a major power decides a metal matters. It does not always arrive with a press conference. It does not need a loud announcement. It often appears quietly, month after month, inside customs data that most people never bother to read. Until one day, everyone wakes up and realizes the vaults in the West are empty and the vaults in the East are full. And China's not the only player here. For the first time in modern history, Russia has officially added silver to its national reserve plan. Read that again carefully. Russia, a country that has traditionally built monetary strength around gold, energy, oil, and foreign currency reserves, has now opened the door to silver as part of its state reserve strategy. In late 2024, the Russian government formally announced that silver would be included in its state reserve fund. That is not a small detail. That is a sovereign-level signal. Because when a state starts accumulating silver, it does not buy a few coins from a shop. It moves in tons. It moves steadily, and once that silver enters a sovereign vault, it is effectively removed from circulation. Since that announcement, silver has quietly outperformed gold on a percentage basis. That is not coincidence. That is footprints. And Russia may not be alone. There are also whispers from the Middle East suggesting that at least one or two sovereign wealth funds in the Gulf region may have started building silver positions of their own. Officially, this is not fully confirmed. Unofficially, the demand pattern showing up in the market only makes sense if large state-level buyers are already involved. Now add the pieces together. China is importing historic volumes. Russia has moved at the sovereign level. The Gulf region may be quietly positioning. India continues absorbing silver through tradition, culture, and demand. That gives you 4 major demand engines pulling from the same shrinking pool of available metal. And while the East has been accumulating, the West has been bleeding. Silver inventories inside U.S. COMEX vaults have fallen back toward pre-tariff levels. That metal did not disappear. It did not vanish into thin air. It moved, container by container, shipment by shipment, quietly, methodically, and mostly toward the East. This is the part of the story the major financial networks do not want to lead with, because it changes the entire pricing narrative. The silver market is no longer being controlled only by speculation desks in Manhattan or Mayfair. Increasingly, it is being driven by physical demand in Shanghai, Mumbai, and Moscow. That is a tectonic shift in how this metal gets priced. For months, silver ETFs in the West were bleeding investors. Holdings were shrinking. The narrative was negative. Sentiment was dead. Then something changed. The flows reversed. Recent data now shows 3 back-to-back sessions of net additions into Western silver ETFs. That matters, because the selling pressure has started to break. And here's the part most people miss. Silver does not need a flood of brand new buyers to keep rising. Sometimes it only needs the existing holders to stop selling. Moving from heavy outflows to neutral is already a major bullish shift. And if Western investors begin coming back in size, the room for demand to expand is enormous. They have only just started walking through the door. Now let's talk technicals, because if you are holding silver or thinking about buying silver, this is where the conversation becomes practical. Silver has moved from the low 70s into the mid 80s in roughly 2 weeks. That is a vertical move, and vertical moves almost always run into resistance. The next major resistance zone is sitting somewhere between 88 and $90 per ounce. The first time silver pushes into that zone, expect profit taking, expect selling, expect volatility, expect the headlines to scream that the rally is finished. But that first test may not be the real test. The second test is the one that matters. If silver pushes cleanly through $90 with strong conviction and real volume, then the next measured move from classical chart structure opens the door to triple-digit silver, and based on that technical structure, some targets stretch well beyond 115 per ounce. Now, on the longer-term chart, some respected analysts in the precious metals space are already discussing numbers that would have sounded insane just 1 year ago. $300 silver, $500 silver. Are those next quarter forecasts? No, nobody serious should pretend they are. But are those levels now appearing on the long-term map? Absolutely. The destination, according to more than one veteran analyst, may no longer be the biggest question. The bigger question may be timing. Now let's step away from the silver chart and look at the macro backdrop, because this is the foundation underneath the entire move. Recent inflation data came in hotter than expected. Consumer prices rose faster than forecast. Producer prices, the wholesale level numbers also came in hot. And here is the truth many retail investors keep missing. Inflation is not just a temporary visitor. Inflation is the dominant macro force shaping the precious metals market for the next decade. Everything else is layered on top of that. Rate decisions, Fed press conferences, political headlines, market commentary. All of it is noise around the core issue, and the Federal Reserve now has a new captain. Kevin Walsh has been confirmed as the next chair of the Federal Reserve. The political pressure to cut rates is loud, public, and ongoing. Walsh has been openly critical of the previous monetary regime and has even used the phrase regime change in past interviews. That phrase carries serious weight in central banking circles. Right now, the market is pricing in a high probability that rates stay unchanged at the next meeting. But here is the important part. Gold and silver have continued climbing anyway. That one fact tells you something major. The era when the Federal Reserve could control precious metals simply through interest rate signaling may be quietly ending. And here is why the Fed is structurally trapped. Back in 1980, Paul Volcker crushed inflation by raising rates aggressively, pushing them toward the 15% zone. He could do that because the U.S. national debt at the time was around $1 trillion. The math was painful, but it still worked. Today, the U.S. national debt is moving toward $40 trillion. Run 15% interest on $40 trillion, and the annual interest expense alone moves toward the $6 trillion range. That is not sustainable. That is not realistic. That is not even theoretically manageable without breaking something much bigger. The tool Volcker used to save the dollar has effectively been removed from the toolbox. That means real interest rates, the gap between official rates and actual inflation, may continue widening. And every time that gap widens, hard assets like silver become more attractive, not less. Now add the next layer. Geopolitical tension is still rising across multiple continents. Fiscal stress is building inside major economies. The silver market itself remains in a physical supply deficit. When you combine all of that, you do not just get a normal trade. You get a regime change in how the world prices money. And this is not only happening inside markets, it is also happening inside state legislatures. Alaska has now passed legislation recognizing gold and silver as legal tender, joining a growing list that includes Texas, Florida, Kansas, and other states. This quiet restoration of metals as money is happening state by state while most of the country is distracted. So let's bring the whole picture together. Silver's recent surge is not a fluke. It is not just a meme. It is not just a short squeeze that disappears next month. It is the visible surface of a much deeper realignment, a shift in how the global monetary system values real physical scarce assets. The East is accumulating. The West is waking up. Vaults are draining. Premiums are rising. The deficit is real. Central banks are stepping in. State legislatures are moving. And the Federal Reserve, for the first time in decades, may not have the clean tools it needs to fight what is coming. If you have been waiting for a moment to pay attention to silver, this is that moment. Not because anyone can promise you the next price tick. Nobody can. Not because silver moves in a straight line. It does not. But because the structural forces behind this metal are no longer hiding. They are in the data. They are in the imports. They are in the inventories. They are in the premiums. They are in the chart. The smart money appears to have already positioned itself. The real question is whether everyday investors recognize what is happening before the next major leg higher makes today's prices look like a bargain. If this analysis brought value to your day, smash that like button, subscribe to the source code if you have not already, and drop a comment below telling me where in the world you are watching from. Your city, your country. Let's see how far this conversation has traveled. OG John AG is out.